When you think of making money using stocks during a recession, your first instinct is to buy low and sell high. As a result, many people look for the market to bottom before buying into stocks. However, it's actually possible to make money on the fall itself, entering the market high and exiting low. So how exactly does this voodoo magic work? Well, it's actually not voodoo magic, and it is one of the most basic methods in the financial community. There are actually two main methods to accomplish this, which are trading options or shorting a stock. Options trading is more common knowledge and something you have probably heard of. An options contract is basically an agreement to buy or sell stocks, bonds, or other securities at a future date at a predetermined price. Typically, an option contract is composed of 100 shares of the same stock or security. An option contract is made with two parts, a call option and a put option. These are basically the buyer and seller. For instance, let's say we have Disney stock that is currently priced at $150. The call option is the buyer, and the contract gives them the right to buy 100 Disney shares at $150 at a future date, maybe 6 or 12 months later. The put option is the seller side of the contract, and the contract gives them the right to sell 100 Disney shares at $150 to the buyer at a future date. As you can see, the buyer is expecting the stock will go up, while the seller is expecting the stock to go down. If the stock goes up to $200, the buyer will benefit by being able to buy the stock for the cheaper $150 price. Similarly, if the stock goes down to $100, the seller will be able to benefit by selling the stock for $150. However, either side can back away at any time. But backing away would mean paying a small fee relative to the price of the stock to the other side. There's a lot of financial jargon going on, but basically with options, you're simply betting on if a stock will go up or down. And there's not much risk, as you can always back out for a small fee. But the main problem with using options during a recession is that it will be very hard to get someone on the other side. You can bet that delta will plummet all day, but it doesn't matter unless you can get someone to bet the contrary. And that's where the second method comes into play, shorting a stock. This is literally when you get in high and get out low. This process starts with borrowing a stock from a broker. And yes, this is something you can do, but you will have to pay them a fee as well as interest on the borrowed stock. Using the same example as last time, let's just say the fees and interest come out to $5. You would start out by borrowing a Disney stock that is currently worth $150. And right when you get it, you sell the borrowed stock for $150. After that, you wait for the stock to drop to your desired amount, which let's say is $100. At this point, you buy the stock for $100 and give it back to your broker along with the $5 fee. In this scenario, you would make $45 per stock. So if you shorted 100 Disney stocks in the same way, you would have made $4,500. Obviously, you can scale this up to millions of dollars and make millions literally buying into stocks on a downfall. But why would brokers do this? Sure, they get $5 in interest, but don't they lose a full $50 in Disney stock value? Well, the thing is, this stock isn't theirs either. It could be, but it usually isn't. They take this stock from people who own Disney stock on their platform and then lend this out. This is not a risk to the real owner of the stock because they can still sell the stock at any time and their platform, whether Robinhood or Webull, will take the loss. But clearly, it's in the trading platform's best interest to find people who aren't likely to sell. To do this, they simply take stock out of owners who have owned the stock for a long period of time, as in several years. These individuals are clearly long-term buy and hold investors, and they aren't going to sell based on economic cycles. Usually, they already bought in quite low. For Disney, this might be an individual who bought into Disney when it was at $75. Trying to sell at $150 and then rebuying at $100 just isn't worth it for them because a lot of this money will be lost to capital gains taxes. So as long as they believe in the company long term, they just hold on to the stock expecting it to reach the 200s. As you can see, everyone benefits here. The buy and hold investor isn't taking any risks and is able to trade on the platform for free. The trading platform is able to make interest on these stocks and continue operation. And savvy investors can make money on a company's downfall and growth. But of course, you should be aware that the savvy investors are taking the most risk. They lose money if the stock goes up or doesn't go down low enough to cover the interest and fees. So casual investors should stay away from this and concentrate on just making money long term. This strategy is generally most beneficial for very experienced investors with large funds and institutional investors. These guys literally bet both ways to minimize losses. Let's say they are 75% sure that a company is going to lose value. They will invest 75% of the allocated funds for the company on shorting stocks and 25% into buying regular old stocks. This way, if the stock goes down as expected, they make 50% profits. But even if it goes up, they only lose 50%. However, as you can see, it's still quite a risky move, so us normal folks should stay away. But that's how the pros who specialize in this area make money on stocks losing value. If you guys thought this video explained options trading and shorting stocks well, then make sure to drop a like and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.